So Brad, it's finally good to, sit down with you and talk about some of the real pressing issues that a lot of companies are facing right now when trying to raise venture finance. So thanks for joining me today.
Thanks for inviting me. It's good to be
pleasure.
here.
Thank you. So Brad, just in your own experience, how do you find the current climate in regards to how it's impacting fundraising?
Yeah, it's a great question. I mean, obviously the markets are dynamic and they're changing. But as we speak right now, I think most people in the financial markets and institutions accept that things have changed. The fact that we've been in this easy money environment for so long with quantitative easing in the United States and in other countries, people kind of just accepted, maybe some people even grew up thinking that's just the way the world is. And It turns out that's not how the way the world is. That's kind of a new thing.
Okay.
But when you cut off the supply of low interest, easy money, then capital goes to other places. It's going to try and find a safer haven. And so right now, with the increase in the Fed interest rate in the United States, the dramatic increase in home mortgage interest, recognizing that for most people, their home is still their most valuable asset. The easy money that everyone thought was readily available by just simply investing in real estate or in startups, that's over, right? And so it really depends on which side of the market you're in. So if you're a tech company or a company that's focused on innovation, those have performed obviously extremely well, both in the private and the public markets. And right now there's just a flight. So if you look at any of the big tech companies, from Amazon to Facebook to Netflix, they in recently just Tesla, they've pulled back. Okay, so where's the money going? It doesn't just disappear. To a certain extent, it does kind of disappear, but it gets redeployed, and it's getting redeployed into, I guess, safer investments, more traditional stocks. So all of a sudden, maybe some of these stocks that weren't cool, like energy stocks, it turns out it's also not cool to lose money. So investors are having to figure out where to deploy the capital. And I don't know if I'm answering your question, but it's a pretty dramatic shift. And I think the question is it transitory, which is what they were saying last year about inflation, which nobody thinks it is anymore, or is it a new normal? And personally, in my life, I've been through a few market corrections. Obviously, the big one for me was the dot-com boom and bust in 1999 through 2001. And then again, there was the GFC, 2007, 2008. But this is big. And I think within the venture market, this is as big, if not bigger, than the dot-com bust. And when I say that, on the flip side, so there's going to be a lot of carnage, already is. But the difference between, say, the current environment and, say, the dot-com boom bust is a lot of companies went public that had no business going public. Okay. In the 90s. I mean, you could go public with, a concept, and that's just not really true. I mean, there was this SPAC sort of bubble there quickly, but even the SPACs, they go public as a blank check. They still have to vend in a real company. So I don't think it's different. I think what's different now, though, is and I know this is long-winded, living over here in Europe, you got some other things going on, like the Ukraine war, or the special military operation, or whatever you want to call it. That's worrisome, and it's unclear how that impacts, things. So whereas in the, say 2000, the Soviet Union, 10 years into the post-Cold War eras, we didn't have the political uncertainty. At that time, China was, I think, just being admitted to the World Trade Organization. Okay, so now fast forward. China's the second leading economy in the world. They're a massive trading partner That wasn't true 20 years ago. Russia, meanwhile, is reasserting its empire or its ambitions. That didn't exist. So it's hard to say, but I would say the current environment is actually perhaps more dynamic than the last one.
Oh, really? So for a founder or a CEO who has a great idea, they really want to develop this idea, and they know that they need funding, but they are aware that the financial climate is very volatile. How could they navigate around this? What could they do differently to stand out?
Stay alive. I mean, I know that sounds flip, but it's true. So the standard, the advice coming out of the Y Combinators and the Sequoias and the well-respected firms that have financed startups are, cut your spend, cut your burn, control your runway to the extent you can raise capital, raise it, but don't try to max out the valuation.
Right.
Just make sure you've got enough gas in the tank to get to the other side, wherever the other side is. Yeah. And but the other thing that's been interesting is, the amount of capital. If you look at how much was being deployed into early stage and emerging growth companies, private companies, it was extraordinary, and it was coming from a lot of it coming from a new type of investor that's never existed before, which is these mega crossover funds that have just massive sums of capital, $20-30 billion. So Tiger, is a good example, and they were doing tons of deals, more than a deal a day.
Okay.
So it's pretty hard. I don't want to say they didn't do any due diligence. I'm not suggesting that, but let's just say they accelerated the due diligence, and they were investing it because the whole idea was, I guess, to get that money into the market and do it as fast as possible. And what that was doing was driving valuations up. It was also meaning that it was easy money for the founders because, if you were in the right, circles, you could get access to capital relatively quickly and on extremely favorable terms.
Okay.
What's happened? Well, it's typical supply and demand. So if you're just a regular old VC fund, and you're competing against one of these global behemoths, it was hard because you were like, oh well, that valuation, those deal terms, that's a tough one. And then these guys come in and they're like, oh yeah, we don't care about that stuff.
Right.
Right?
Yeah.
But now they're gone.
Just like that.
Just like that. They're having massive write-downs, and they're basically having to do what everyone else is doing, which is, okay, look, we need to preserve capital. We need to make sure we deploy the capital into investments that make sense for our limited partners. Right now, we're taking massive write-downs within this one sector. Maybe we should slow down. And so turn off the spigot to that sector, turn on the spigot over here, which leaves the people who had the original funds specifically raised to finance startups, VC funds.
Right.
Now all of a sudden it's like they've swept out the competition, or the competition has voluntarily stepped away from that. And so the money's still there. There's still plenty of capital. It's whether there's still appetite.
I imagine the appetite's much less for, early stage startups and businesses that are just starting out.
Yeah. So, the early stage stuff, everybody all of a sudden became an entrepreneur, right? Yeah. It's like living in LA. Everyone thinks they're going to be in the movie business. But globally, entrepreneurship just became cool, and everyone was doing it. Turns out it's probably less cool today, and I would predict in 12 months, a lot of people who were playing around with the idea may decide actually working for the bank is not so bad after all. But we'll see. But that's my prediction. And so the nice thing in any down market is it cleans the system out.
Okay.
You saw this totally. I mean, in Seattle, where I was in 2003 or four, it was a very different scene than 2000, the year 2000. The year 2000, it was booming, right? And then 2001, pretty much people got the memo that, you know, maybe the party days are over. 1999 is now in the rearview mirror. And literally for quite a few years, you know, things really slowed down. It didn't mean that there weren't still great companies.
Right.
In fact, you could argue some of the best companies, you know, that's
Yeah,
but it wasn't just crazy. You didn't just have to get up and do a belly dance and have somebody throw $1 million at you. You know, you have to actually kind of have something and prove it. So I am not worried that startups won't have access to capital that they need. But I also am confident that some of the companies that did get capital probably need to dramatically slow down the burn. And the next time they need to raise capital, I think a lot of them will be doing so on very different deal terms.
Okay, that would make sense. So, I mean, do you feel that there's certain jurisdictions that are more appealing in terms of raising funds, or perhaps have more appetite for risk even during this current climate?
Well, yeah, and there's global league tables that show, you know, where the money is coming from and where the money's going to. Over the last, you know, several years, there's kind of been a global rise of the rest. You know, so in the United States, the money has historically gone to California.
Okay.
And then a few other pockets: New York, Boston, you know, Seattle, Boulder. I mean, but if you really look at where's the real money was concentrated in California. It was both coming from California and being invested in California, particularly Northern California, San Francisco, Silicon Valley. So then there was this hypothesis, I think it was Steve Case, founder of AOL, who said, hey, look, what about the rise of the rest? What if you're a tech startup in Memphis, Tennessee, or Nashville, or let's say you're in Minnesota, or even Chicago, for that matter? What about the rise of the rest? And that was starting to happen. And I think it's a good thing, right? Especially, and I think COVID, the idea that you can do a deal over Zoom.
Yeah.
You know, that also facilitated this whole idea that you know, you can start a great company from anywhere. I have a good friend, started a VC fund originally in Seattle, moved it over to Boise, Idaho. He said he's just killing it over there. There's some good stuff happening. So Boise and places like that, Bozeman, Montana. I mean, all kinds of places. But that's in the U.S. Now, what about the rest of the world? So you look, you know, at Europe, and Europe has come a long ways. I mean, in the last 10 years, it's, in terms of the amount of capital, it's dramatically increased. I think, you know, last year it might have even gotten up to about half of what it was in the U.S., which is big rise. Yeah. And then where does that capital come from, and where does it go to? Obviously, the U.K. is by far the leader, but there's other, you know, tech centers. You know, there's Berlin, there's Stockholm, there's Paris, and then there's these other small markets. You know, frankly, in terms of venture capital per capita, it used to be that Israel was the world leader.
Yeah.
And now it's Estonia. The Baltics are killing it. So, but Estonia is a small country. They've had, you know, some dramatic unicorn success stories, and you know, I guess it's just math that if you have a couple of huge wins, which they have had, that their average venture capital per capita in Estonia is now higher than Israel. Okay, that's crazy. You know, who would have thought? But the other Baltic nations are doing well. You know, Latvia, I've got some deals up there, and Latvia and Lithuania has had some success. You know, the Nordics, of course, have always done well. Switzerland. where is having success. So I guess my point is, innovation can happen anywhere. Capital is both coming from and being deployed more broadly.
Yeah.
If that answers, I don't know. Does that answer the question?
It does. It does. I guess also it's just from the perspective of an entrepreneur who has a great idea and they want to develop their MVP, and they are approaching investors. They are going online. They are making applications. They're sending cold emails. They're doing everything they can, but they've been rejected. They've been told no. So for someone in that situation, it's very disheartening.
Sure.
And also considering the current climate is very volatile. So I guess it's how does one navigate oneself in a situation like this? For instance, you've mentioned some jurisdictions that maybe have a much higher rate of investing into startups. So would an entrepreneur perhaps travel or leave their jurisdiction in hopes of getting funding elsewhere?
Yes. My personal view is that you fish where the fish are, right?
Okay.
And so if you're trying and you are unsuccessful at attracting the capital that you want or need within your local market, you need to go to other markets.
All right.
I mean, that's, and fortunately, the capital is more readily available than it used to be to invest in non-local markets. So in the old days, I think it was conventional wisdom that angels typically wouldn't want to make investments that were for companies headquartered more than, say, 2-hour drive, just too
Okay.
far. That's not true anymore. I mean, at least not within the circles that I operate. People are willing to make investments in the United States, across, really anywhere. Obviously, California is where a lot of the companies are, but there's nothing wrong with investing in a company in Mississippi, if that's where the thing is. But globally, and I have been living outside the U.S. for quite a while.
Yeah.
Here in Europe, is very common for both angels and VCs to invest across borders.
If you're an owner of a company in, let's say, a jurisdiction that typically doesn't attract investors, and you do need to raise financing from third-party sources, what could you do in this current climate?
Yeah, that's a tough question. First of all, I would do my homework.
Okay.
And I would put together a team of advisors who understand the challenges and understand the different pathways and solutions to figure out how to get you access to the types of investors that will fund the venture. So I guess one of the key questions is, where is the talent located?
Yeah.
B, where are the customers located?
Okay.
And it's not uncommon in my experience that if the customers are located in a place where there's a lot of capital, that their investors within that jurisdiction are also willing to fund ventures that may be headquartered in another location, right?
Okay.
Because they're confident that the dogs are eating the dog food.
Right.
If the dogs are eating the dog food, it doesn't matter that much if the dog food's manufactured in X or Y or Z, putting aside political risk.
Yeah.
If there's political risk, obviously, that's another issue. But even then, you might say, okay, hey, look, the team is fine. Maybe we need to, let's just take Ukraine. In the case of Ukraine, let's try to get as many of the team into other places where they can continue to create value, but in a more stable political environment. So that's happening a lot. At least I see it happening a lot. But the short answer is, if you're stuck, and it sounds kind of like that's the question,
Yeah.
you need to figure out how to get unstuck. And sometimes that just means you need to build a team, a coalition of people that are going to help you go under, around, or over that problem.
Yeah, no, that's been really, really helpful advice and a really good insight, especially from your perspective, Brad, and the experience that you have. So I think, our viewers and our listeners who are maybe stuck in the current climate would find that very useful. So thank you very much for sharing your
glad to be here.
insight, and looking forward to speaking again.